Arvind Sanger, Managing Partner with Geoshpere Capital Management, who joins us all the way live from Hong Kong. Arvind, good morning. Thank you for joining us. Arvind, a lot has changed for Indian markets in last 3 weeks. Reserve Bank of India has moved, earnings have disappointed, bond yields have gone up, and rupee also has cracked. Is the environment making you slightly nervous, or this is a time to buy into the fear?
Well, I think that, if you look at the Indian market, other than the global fears which have overhung, all emerging markets, India has its own unique problems now with RBI defending the rupee with this sharp rise in short-term borrowing costs. And that creates a risk of economic impact being quite negative in terms of a transmission of these higher interest rates into both the corporate and the consumer sector, and therefore resulting in some impact on the real economy. I would say that the Fed statement today from the U.S. Fed was along expected lines, which is why the market didn't have much of a move up or down, and it was pretty much more or less unchanged from where it was, maybe off a little bit from where it was before the Fed statement came out. So I think the Fed is clearly, trying to signal that it is not going to do anything dramatic, and therefore it is not going to withdraw liquidity in a hurry, which should be somewhat, positive for the Indian rupee and for Indian markets. But I think, frankly, at this point, the picture on India has become far more cloudy than almost any other emerging market because of this sudden decision by the RBI and the government to take this drastic action. Well, I guess drastic may be too strong a term, but to take this surprisingly strong action to support the rupee after having watched some seemingly unconcerned as rupee went from the low 50s to across 60, and then suddenly seeming to be in a somewhat, panicked reaction almost, it seemed, in terms of the very sharp couple of announcements that have been made on short-term rates.
So, Arvind, what's the right way to approach Indian equities now? Is it time to buy in, start cherry picking, or do you think the market has further correction in store and we're going to get better opportunities?
I really think that, unless the global environment such as U.S. economic data turns out to be surprisingly slow at this point with the recent RBI move, I think India is in a sell the rally situation. I mean, you don't buy the dips, you sell the rallies, because I really do believe that the GDP growth is now set to disappoint in terms of what we were looking for, which was a recovery into the mid 5s or 6% over the next few quarters. That looks increasingly difficult to foresee. And I think the only the reason to buy the market in the near term is going to be if you get an early election announced, and then there is some optimism that that election might result in some kind of decisive outcome that might cause investors to have that as a possible bull event to hold on to. Otherwise, if the elections are coming next March, April, May, and in the meantime you have this supposed temporary policy. But I think, as we saw when the RBI governor talked about this policy being temporary, the rupee sold off very quickly. So I think India has kind of painted itself into a corner where I just don't see a reason to get too bullish. I think the trading range, in my opinion, has a downward bias rather than an upward breakout potential. Again, unless the U.S. Economic data comes to India's rescue. India's own situation, I think, looks rather disappointingly, limited in terms of upside.
Is the downside, though, protected at 5,500, or do you think there is a chance we could slip further?
Well, I think to some extent it depends on how the rupee behaves, and the rupee, frankly, is where it was when before RBI did its policy action. So, frankly, at least from the short-term reaction, the bullets of the RBI have been wasted. Therefore, I think the reason that I, at this point, would have to say that 5,500 is no longer my lower bound of where the market can go is because I think given the tight squeeze happening in terms of higher interest rates driving further, stress on balance sheets for corporates and also potentially for consumers, as well as continued rise in oil price and everything else that squeezes the consumer, a good monsoon alone is not enough to save India from what I think could be, some potential that if the RBI tries to take its foot off this high interest rate regime, or at least a high short-term interest rate regime, the rupee could take a step to weaken further, and therefore that would put downward pressure on the market. So therefore, I would say the risks are, and I'm saying this for the first time in quite a while, that I think the risks are that 5,500 could be breached on the downside. I mean, I'm still hopeful that it's not a huge amount of downside, but at this point, there's no way to say that that there is either an identifiable bottom on where the rupee could go if the RBI steps back, or where the market could go RBI. I hope I'm wrong. I'm cautious and I'm willing to change my mind, but at this point, I think the clouds look pretty gloomy out there.
Well, on rise market, so what's the right approach then? Because the only pockets which are rising right now have been IT, select pharma and FMCG. Is it time to book out of those spaces as well?
Well, let's examine that, because the IT and pharma are beneficiaries of the rupee weakens, and IT and pharma are not dependent on Indian economic growth. So I think those sectors are relatively, very much less impacted by what I see developing, and the risk that I see of a slowdown is really where the consumer sector. I mean, at the end of the day, if the Indian current account deficit is going to have to be fixed, it's not going to be fixed because suddenly, despite any export incentives that the government offers, that suddenly the exports in India are going to go through the roof. We've already seen that the weakening rupee has not helped their exports much. It's going to have to come from a consumer demand slowdown. Now, you would wish that the government could have such a fine, tool to use that you could only slow down items which are imported items, and all domestic demand would be unchanged. But we all know that economic actions don't work that neatly. So I do think that the consumer sector, the FMCG sector, and other consumer stocks are very much at risk given the kind of valuations they're trading at, and given the fact that part of the next step of slowdown, if we're going to fix the current account deficit, is going to have to be some slowdown in consumption. And it can't all be just, we'll ban gold and we'll go back to the 1980s, where, gold smuggling is a big business in India because the Indian government has decided in its wisdom that the Indian public has no right to own gold unless they say so. So, that may be one policy, but I think there will have to be, unless the government is going completely in that route, I think there'll have to be and there will be some slowdown in consumption, and therefore, I think that is a risk for the markets.
Arvind, do you think more than anything else, it's the over ownership of Indian equities by global investors which poses the biggest risk in the near term? Because if I look at India pretty much is right up there when it comes to global allocation. We've attracted about $30 billion of equity money in last 2 years, and if that money reverses, we really could be staring at a very ugly market.
I think you're not going to get the entire reversal there, but there is some risk that some of that money leaves, because at the end of the day, as we've seen, the foreign debt money that the government was so keen to attract in the last several quarters to plug the current account deficit proved to be extremely fickle, and it was really not buying the India story; it was buying the spread story in terms of what they could get on yields in India versus what they could get elsewhere in a market where the currency was assumed to be stable. Now that story is over, the people there are still on the equity side, people invested in India counting on the equity story. If that equity story hope of improving earnings and therefore market on a cusp of a turn gets pushed back substantially, there is a risk that there could be some outflows. And frankly, the one clear message from the last several years is that Indian domestic investors are completely out of the market. So yes, you're right that because Indian domestic investors have largely abandoned the equity market in terms of incremental capital flows coming in there, the foreign money becomes that much more exaggerated in its importance, and therefore, yes, if that does withdraw, if the rupee continues to look shaky, then the downside risks on the market are somewhat exaggerated in that case.
Arvind, final question. So at the current juncture, what is your portfolio strategy, both globally and locally, and within Indian equities? Are you still happy to own IT?
I'm happy to own IT, and I'm happy to own some of the oil and gas companies that are benefiting from some policy action there, which is actually pretty favorable in terms of gas prices, coming to some rational price in the future, and some exploration upside, because that is one of very few areas where you could actually see some corporate capital expenditure rise. So I think that that at least one part of the government has figured out what needs to be done right. But on the other hand, I am looking to short names that are based on domestic consumption, or some of the capital equipment sectors, specific names there where I think the story continues to be challenged on a multi-year basis, especially in the power sector. So I would say that I don't have any position in financials, but financials are a tough place right now because on the one hand, valuations have gotten to relatively attractive levels. On the other hand, all of what's going on the policy front and on the interest rate front makes it rather difficult to get too excited about jumping into that at current valuations.
Arvind, pleasure speaking with you. Really appreciate you taking the time out and chatting with us today on ET Now. That's the view coming in from Geoshpere Capital's Arvind Sanga.